Hello and welcome to BQ Prime. I'm Hiral Dadia. One stock that's in focus today is Happiest Minds. They've reported a year-to-date revenue growth in constant currency of 26% and an EBITDA of 26.3%, which is well above the guidance as well. Welcome to the show, gentlemen.
Hi, Hiral.
The first question coming to you is overall, in terms of the numbers that have been reported, we have seen growth that has come in. However, there has been a sequential decline on the margin front, as well as a sequential decline in profits as well. Have the numbers overall met your internal expectations, Venkatraman?
The revenue growth, you're right. I would have liked to do better on the sequential growth front, but we had certain unusual circumstances. There was one less working day, and there was also leave and holidays which were taken by people far in excess of what has been the trend until now. So if you adjust for these two things, these two numbers, we are back to the 5% plus growth rate on a sequential basis, which is where I would have expected it to be. But that be so, overall, on a 9-month basis, we've been able to meet our margin guidance as far as revenues are concerned. And on the, revenue growth is concerned. And as far as margins are concerned, we've been able to beat it by a nice 2 percentage points, because our guidance is 22 to 24%, we are at 26%. So EBITDA has been better and continues to be strong. So even if you look at only for the quarter at 26%, it's ahead of the guidance that we said. Overall, so financial performance has been decent. But looking a little forward into the next quarter, and also the market conditions, we are reasonably confident of meeting the margin guidance that we have made for the year. So on the financial front, that's how it looks.
Right. So overall in the quarter, we've seen around 9 additions from a client perspective. How is that scenario panning out going ahead, taking the global market scenario into consideration? Because a lot of chatter that's going on with regards to recessionary fears globally, right? So how are you seeing that trend pick up from here on?
Sure, Hiral. If you just see the and you made a very valid point of 9 logos, which and what I want to point out over here is distributed across all the geos. We had 3 in India, 3 in North America, and 1 each in Middle East and ANZ, which shows that there is demand out there. And we ended the quarter with a pretty strong pipeline. And as we speak, in the first 2 weeks of the quarter, we've already had a couple of closures of reasonably decent size. So overall, I think the demand, while customers are taking a close look and prioritizing their initiatives, they still need to implement their digital initiatives. They need to make sure that they modernize their platforms, and that work will continue. What they're doing is prioritizing the initiatives that would give them either strategic benefit or immediate or quick returns, and ensure that they invest in those. So as long as we're able to identify those initiatives and work with the customer, I think the demand is out there.
Right. I think in the previous quarter commentary as well, you've clearly given an indication about robust deal wins and healthy pipelines that will actually be backed by digital services, right? Though there were a slight delay in large clients. So is that, deal win momentum continuing? And also, are we seeing a delay in the large clients? Because right now, the trend that we've been witnessing is the project that have been awarded are all short term. A lot of clients are cautious with regards to awarding, longer tenure deal wins.
So, I think that the trend that you talked about, may plays to our advantage, because we work with customers more on land and expand kind of a strategy. So you get in, work on some of their initial, ideation, thinking of how do you map the business requirements to their technology roadmap. And once you show them that the benefit from that, you continue the implementation. And therefore, we're not looking at those large programs, the $10 million, $20, $30 million. So in a way, it plays to our advantage, the approach that we've taken. And in terms of the deal closures, historically, December tends to be a slightly slow month because the budgets are going to get released in January. Customers tend to, and you have a holiday season. So if deals are not closed by mid-November, they tend to slip into Jan, and that's what we are seeing. Some of the deals that didn't get closed in December, we're seeing them fructify in January, and we expect that to continue during the quarter.
Right. So what percentage of the revenue is coming in from new businesses, and what is expected to come in from existing from here on, if you have to take a breakup in terms of percentage terms?
Our repeat business is around, for a quarter, varies anywhere between 90 to 92%. And if you look at it on an annual basis, it'll be around 91% typically. And that, I think, will continue for us because there is a lot of focus on account mining and expansion. At the same time, we have to ensure that we keep getting in new logos, which acts almost like firewood that you'll be burning next year. So we expect this ratio to continue for us. We are quite comfortable having this 90-10 or 90-8 kind of ratio.
Right. And overall, from the existing clients as well, one of the large clients you had mentioned in the previous quarter was cautious about spending in the last quarter, but had shown significant confidence spending more as they were likely to add more features in their product platform. Any update on that one?
So, what they've again done is they've taken their budget for the year, broken it up into quarterly budgets, unlike earlier. And so they're continuing to add functionalities and features that work has started, but they're following the same trend that I talked about, prioritizing the initiatives that will impact customers immediately or in the near term. And those are the projects that we've started working on with this customer.
Right. Overall, if you see from a utilization and a perspective, attrition at around 20.9% for trailing 12 months. Utilization has seen a mild drop coming in here. What is that actually indicating for a business like ours?
Venkat?
In terms of utilization, we ended the quarter with about 80.1%.
Yeah.
As we have said in the past, an ideal utilization level would be about 78 to 79%, giving us a headroom to do additional business. So if you look at it, we are ahead of that from our own estimate, ahead of on that count on ahead of our own estimate. So it's looking fine as of now. The next quarter, we would see a drop in utilization slightly because we've got the campus program. The joinees, about 215 of them coming into the mainstream workforce, which could affect the utilization by a small percentage point. And the objective of the business would be to have them become billable at the earliest. And billing starts from anywhere between 6 to 9 months, or even between 6 to 12 months. So we're not overly bothered right now on the utilization front. And as far as lateral hiring is going, with regard to the availability of talent, yes, the talent on the digital front looks scarce, looks difficult to get, but we are able to manage as of now.
Right.
The declining trend on attrition, we are at about 20% on a trailing 12-month basis. We expect that to trend downwards further and go back to the 15% number as we have seen in the previous years.
Right. So that's overall. And do you think this attrition, as well as the new recruits that we are talking about, that's something which could probably put some bit of pressure in terms of where margins go?
If you look at the new additions, the campus additions, they have been there in the system for the last quarter and this quarter completely. So it is post that cause we have done the 26% margin, as you see. So that's not going to impact us. And as far as laterals are concerned, it's part of the business flow. So we recruit on a demand base or on a planned basis. We address that through our normal business flows.
And actually, Hiral, if you look at the campus patch, that's a lever that we have actually, because the cost is already baked in. And if hopefully the businesses and the deliveries teams would be able to start getting them built, and as and when they get built, it will add to the top line.
Right. So overall, if you have to look at the various business segments, right? Clearly, we've been talking about digital infrastructure, cloud, SaaS as being, as the key focus area. So if you have to divide it between these as well as, EdTech, BFSI, industrial, where are we seeing higher traction, and which are the segments where clients are focusing on cost optimization?
the digital infrastructure, SaaS, etc., more of horizontals cutting across all the verticals, right? And if you in fact look at the verticals, and if you look at our Q3 numbers, I think all verticals have continued to do well. Some of them have seen a little bit of change on a quarter-on-quarter basis, but there are specific reasons. Like in some case, you would have finished a fixed price project and would have recognized, the last part of the revenues, which tends to be lumpy and one time, and that's what has accounted for these, changes quarter on quarter. But overall, all of these verticals need to continue doing they're completing or working on the digital initiatives. So if you find the right use cases, there is opportunity in all of these verticals, and I don't see any of the verticals sort of holding back. Some of them may be a little bit more aggressive than the others. If you look at manufacturing, industrial, they need to optimize their supply chains. They need to ensure there's more plant automation to factor in for availability of talent and people moving out of the workforce. If you look at retail, there's a lot of e-commerce that they need to support, and also on the supply chain, because that's been a huge pressure. And in terms of edtech, the whole, I think a lot of the universities and schools, their eyes were sort of opened when they had to do this remote working. They thought they had solutions, but it was more of PDF content that they had, not interactive, and so they have to continue investing in more of the adaptive learning, immersive learning, and things like that. And there are a lot of new technologies coming, whether it's Web 3.0 or Metaverse, which enables them to do that. So I see the demand continue in all of the verticals, as long as we can identify the right use cases and initiatives, and then approach the appropriate people.
Right. So overall, from a revenue model perspective, when you talk about T&M and fixed price, right? Now, T&M is majority portion of the revenues. Are we seeing a shift happening on that front as well? Number one. And number two, in terms of the regions as well. I mean, US is talking about, recessionary fears. Are we seeing any concerns from a US perspective? Because again, 67 to 68% of our revenues come in from the US.
Yeah. So in terms of the split between fixed price and T&M, we've not seen any movement. And I think doing a fixed price in the digital initiatives is a little bit more difficult, because the customers do it in a sequential manner, and very often they have to change the sequence and what they deliver based on customer feedback. They constantly, it's a very agile way of doing things. So they do maybe a month delivery, and then get feedback, look at the reaction, and then change their plans. So they tend to go more for T&M because of that. And in terms of the recessionary fears, as I said, I think one area where customers are being a little cautious is Europe, because of what they've been impacted more than the rest of the geo from what was happening in Russia and Ukraine. But even there, we as I said, we had one closure last quarter, and we expect that we would have the traction build up again in this, because we finished 1 year, going to finish a year of the war as well in another couple of months, and people are sort of settling down that it's this is for the long haul, and you have to continue doing your things. The drop in energy price also is helping out in Europe, and if that continues, I think it'll give them breathing room.
Right. So very lastly, are we confident of maintaining the current margins from here on, and overall the guidance for FY23, and or do we expect a material shift that could happen?
As I've said in the past, taking a shot at future margins is as difficult as predicting the weather. 22 to 24% is what we have called out as sustainable margins, and that's the guidance that we have given. Though we have been fortunate to have delivered higher than those numbers for the last 10 quarters, including this, that would be the 11th quarter. Yes, we'll continue to strive to do better, but the guidance is going to be more in the range of 22 to 24, and we'll continue to invest in business. I think that should be the takeaway from here.
Absolutely. Thank you, Venkatraman. Thank you, Rajiv, so much for joining us on the show. Pleasure to speak to you. Congratulations for the numbers and good luck for the coming quarters as well. Thank you. Stay safe.
Thanks a lot, Hiral. Thank you. You too. You too. Bye-bye.